Good morning and welcome to the Killik Go podcast for the 20th of November. This week the main catalyst for markets has been the FOMC minutes, so we've got further evidence that a rate rise in December is pretty much nailed on, which will take that lift-off discussion off the table, which should be a relief because it's been going on for quite a long time. We also had reassurance that the trajectory of rates rises will be very shallow, and so this week we saw the Treasury yield curve flatten in the US, so the likelihood of rates going up and an increase in yields around the 2 to 3 year point of the curve, and the long end of the curve actually coming down a little bit to reflect that sort of realization that the current rates are actually about right in this environment, not too accommodative. We also had some CPI data which for the first time actually beat expectations for a long time. So we do feel that the US economy is normalizing. We're getting further evidence of that. It's interesting to look at the US CPI services, excluding energy, which is kind of the part of the main part or engine of the US economy. The inflation rate there is now back to, well, it's now up at over 2.5%, which is well beyond the level that the Fed is chasing. So you can see a very big rebound in that chart there. So, we do feel that wage inflation is coming into the market. We're seeing a tighter labour market. We're starting to see inflation in certain pockets. And this will return from corporate returns over to labour. So margins will compress and employees will get more in their pocket every month. So this is why we're long consumer discretionary stocks. Now, this sector's had a real mixed picture this year, and inventories in consumer stocks have gone up quite significantly. So there's quite a lot of worry going into this very important period for retailers about the level at which they're going to have to discount that inventory to get it off their hands. So we've seen sort of a lot of momentum in these stocks sort of stall a touch. But where we are seeing continuing momentum is in the leaders in social commerce. So just explaining social commerce, these are retail transactions that are driven through online social networks. And in 2014, we had 3.3 billion through these channels, which is about 1% of the e-commerce, which is only 10% of the overall number. So, but what we do see is the e-commerce is growing quickly. So e-commerce is expected to go from 10% to 20% of transactions by 2020, or 332 billion to 535 billion. So that's the area of the retail market that's growing the quickest, and within that, social commerce is growing the quickest in that category. So the leaders in this space are Nike and L Brands and Michael Kors. So Nike this morning raised their dividend by 14%, increased their buyback, so they're going to be buying $12 billion of stock when the current buyback expires, and the stock price was up very strongly after hours before the open today. L Brands also had their results this week, and they came in at the top end of expectations. So we're seeing that sort of the leaders in social commerce are leading the way in terms of sales in an otherwise sort of slightly damp sector. But Michael Kors has had a significant de-rating, as you can see from that chart. So this is the PE of Michael Kors. We were trading at a very lofty multiples back in 2012. And down here we are around 9.5 times forward earnings numbers. So over the last couple of quarters, we've seen Michael Kors' earnings stabilised, having been falling. And we now think that it's the right time to start looking at this stock again, because we feel that on 10 times earnings, it's pricing in a great nervousness about the relevance of Michael Kors as a brand. But we are seeing their e-commerce sales grow quarter on quarter by 140-odd%. And we think that given their position in social commerce, that they are still very much relevant with a growing demographic that is very important for future sales. So again, we're looking at that stock again. We also had the ECB, Draghi, talking this morning, confirming that growth in Europe is weak and headwinds have increased. So Just worth pointing out that the euro has been extremely weak. So in terms of euro against sterling, we're back up to those previous highs for sterling, lows for euro. We also had the German government sell 2-year bonds to the market at minus 0.38% this week. So here you can see the Bund curve, and you can see that we've got negative yields going out for 7 years. And the expectation is that we get a further 15 basis point cut to the bank lending rate, which is currently minus 20 basis points. So this is a real effort to encourage people to not hoard money in banks and go out and spend it. But what it's doing in the market is it's making the defensive stocks in the European market outperform the overall market. So here you've got the MSCI Europe, which is the market, and you've seen the performance of telcos and real estate. And this is an interesting theme because if, for example, property businesses are able to borrow at very, very low rates and reinvest in real assets that are giving a good risk premium to the yield, then you're seeing a good compounding of earnings there. Next week, again, it's a relatively quiet week. On Monday, we've got Palo Alto, which will be very interesting, which I'll talk about. We've got Compass Group on Tuesday with Babcock and a number of others. Wednesday, United Utilities, chiefly of interest there, and Deere in the States will be an interesting one. Thursday, we've got Marston's, one of our mid-cap stocks, which will be very interesting. Seadrill there, who've been having issues more recently. And then Friday, Pennon in the utility sector, and Naspers. So just going to Palo Alto, this is an interesting stock that we've been doing a little bit more work on, still got a bit more work to do. But it's got a very fast-growing total addressable market. We all know cybersecurity threats are growing rapidly, and the requirements, both regulatory and just from corporate protections to address those, have grown. So it's a chief area where technology spend is happening at the moment. So Palo Alto is forecasting a 35% 5-year compound annual growth rate of revenue, and we think that now is actually quite a good time to be looking at Palo Alto. So through the Q3 reporting season, we've had some fairly mixed numbers from their competitors, but the survey data that we're seeing is that Palo Alto is actually winning market share from their competitors, and the business has a platform of solutions which the main ramp for this platform was in 2010-11, and the products have around a 5-year lifespan. So we're seeing good renewal rates for their existing customers, where they're taking on more services from Palo Alto. So we think that will support Palo Alto, and we'll get a feel for that in their numbers on Monday. Finally, Compass. We've been getting a little bit more negative about Compass, just on concerns that it's exposed to capex cuts in oil and gas. So they provide catering services to a lot of offshore and remote operations. This business is about 16% of revenue, and it's high margin business, so it's a bigger contribution to the profitability line. So we're just keeping a very close eye on that going into their numbers this week. So that's it from me. Thanks for listening. Have a good weekend.